Hello and welcome to the Construction Record Podcast. I'm digital media editor Warren Frey. On this episode, I have highlights from the Construction Economy Outlook webcast titled, What is Normal Anymore?, presented on May 9th. The event featured a group of economists and construction experts, including Associated General Contractors of America Chief Economist Ken Simonson, American Institute of Architects Chief Economist Kermit Baker, ConstructConnect Chief Economist Alex Carrick, and Senior Economist Michael Guckes, as well as ConstructConnect Vice President of Content Acquisition Morgan Stinson and Paul Hart, the Vice President of Product Marketing. Kermit Baker looked at recent trends in construction activity as well as the outlook for this year and into 2025. Here's what he found.
Looking at construction spending for the year in 2023, and it was a very, very strong year for construction last year. Spending, as you can see, was up in excess of 20%, almost 30% for the commercial industrial side, about 10% for institutional. Particularly on the commercial industrial side, there were just a few key segments that were driving that growth. In particular, the lodging number was very strong, almost 20%. Manufacturing really kind of off the charts with 70% growth. And then on the institutional side, much more uniform in terms of the growth rates. Most of the sectors were in the high single digit or low double digit rates. Same sort of numbers for the first 3 months of 2024. So kind of how this year is starting out. Those are the most recent numbers we have through March of this year. And you can see overall spending still pretty healthy at 15%, down from 20% last year. Commercial industrial is flagged a little bit at 15% when it was up to almost 30% last year. Institutional, on the other hand, a little bit stronger, moved from 10% to 15%, as you can see. I've got a couple numbers circled here, kind of focus on the areas that are a little bit weaker and the areas that are a little bit stronger. So on the weaker side in commercial industrial, lodging, that was up 20% last year, now only up less than 1% through the first 3 months of this year. Manufacturing, still a very healthy number, but down to 30% growth from 70% growth in 2023. On the institutional side, education strong, went from 13% up to almost 20% now. Religious and public safety, also strong growth, but much smaller numbers. Education is the largest institutional sector, so certainly the growth in that sector means a lot in terms of spending throughout the construction industry. The weakness that we're seeing in many commercial sectors is raising concerns that we may be in for a broader meltdown. So we've seen steep declines in commercial property values in most markets. I'll talk in a bit more detail about that in just a minute. Currently, about 30% of paid work days are worked remotely, and this year has been fairly stable for quite some time. Doesn't seem to be moving down anytime soon. So it looks like it's sort of stabilized at that 30% working remotely. National office vacancy rates are near their all-time high. We haven't really seen the bottom yet. Many office leases have not yet come due in the current environment. There's going to be quite a shock as they do come due. As loans come due, payments will need to increase, although we're seeing a lot of extend and pretend, as it's called, just sort of moving forward on current leases to avoid the problems that they might present. And that really only serves to kick the can down the road. So we're still going to be dealing with that in the future. We could see a growing number of loan defaults, which disproportionately impacts smaller community banks, and they seem to be at risk now too. So the market has coped with these conditions so far, and hopefully will continue to, but there are still some serious risks out there that we're going to be dealing with. And the next slide looks at inflation in construction costs, and that remains a big concern. So inflation in inputs to construction is currently just about flat as compared to year ago levels. Key inputs into construction, lumber, steel, copper, plastics, glass, all are negative relative to year ago levels. Salaries and services, the yellow bars in the middle there, are still trending up and are likely to continue to trend up. So the commodities numbers, the red bars, are going to fluctuate a little bit, some plus, some minus. Overall, I don't think we're going to see much change in those moving forwards. Wages and salaries are likely to continue to trend up in coming months. So all told, probably we are going to see some increase in construction input costs. I'm guessing it's going to stay in the low single-digit range for the time being. So, construction costs have been relatively stable over the past year, as we saw on the prior slide. They are well above levels they were at the onset of the pandemic. So when the pandemic hit, we saw construction activity pause. We saw prices hold pretty stable. And then they began to accelerate beginning around mid-year 2021. And so for 2021, the year as a whole, we saw input costs increase by more than 15%. In 2022, that pace of increase accelerated a bit more to about 17%. Before beginning to level off starting early last year. So they are flat now, as I mentioned, but as you can see, they're up kind of 35 to 40% relative to pre-pandemic levels. And I think the likelihood of going down anytime soon is very, very slim. And then finally, let me end up with the forecast. These are numbers from the AIA's consensus construction forecast. We publish these numbers twice a year, and they're compiled from the leading forecast firms across the country. These results I'm showing here were released in mid-January. What was their outlook for this year and next year as of earlier this year? Well, after strong growth last year, as I mentioned, very strong growth in 2023, forecasters are predicting a fairly dramatic slowdown this year and next. Overall spending on non-residential buildings is projected to increase a mere 4% this year, only 1% in 2025. These numbers are not adjusted for inflation, so real growth would be even lower than that. The commercial sector is expected to see no growth. Manufacturing, healthy growth this year for projects currently in the pipeline, currently under construction, and then spending stalling next year to no growth. And institutional, certainly by comparison, doing better than the others, only modest growth, low to mid single digit this year and next, but at least one sector that looks to have some increase in construction activity moving forward over the next couple of years.
Ken Simonson examined construction employment as well as material and labor costs and how much the industry is spending.
Let's move on to what's happening with construction employment, and then I want to get into materials cost availability and where I think different segments are headed. The first slide here shows that non-residential construction employment has been growing very strongly for the past year and a half. Most recently, about twice as fast as total non-farm payroll employment, shown by the green line. But the surprise in this, I think, is that residential employment has actually been positive on a year-over-year basis throughout the whole time period. It certainly slowed down a lot from the torrid growth of early 2022, but it's still beating the total non-farm payroll employment growth. However, that really indicates that contractors are having trouble finishing up multifamily projects while the single family is starting to grow. I'll say a little more about that later, but let's get on to a picture of where the growth has been occurring in employment. These figures come from the Bureau of Labor Statistics. They get updated 2 weeks after the national employment figures. So at the moment, they lag by a month, but they're pretty consistent from month to month. The year-over-year change has been positive in 39 states from March of last year to March of this year. And the colors do dance around a little bit. There's no great regional pattern, although more weakness in the Northwest and the Northeast. The strongest growth has been consistently throughout the South and the Inland West. Looking at the next slide, we can see that the industry is still facing a challenge of finding enough workers. Here, the blue line shows the number of job openings on the last day of a month, in this case, March, every year from the beginning of the series in 2001. The red line shows the number of people hired during the month, and that you would expect would be much greater than the number of openings on a single day. That was true from 2001 until around 2019. But in the last few years, job openings have continued to rise most of the time, while hiring has more or less stagnated. And as a result, the industry has almost as many openings, or some months more openings at the end of the month than it was able to fill during the month. So I think contractors wanted to hire twice as many people as they were able to find, and more of those states would have been in green or brighter green than you see. Well, let's move on to construction wages. This is a series that comes out with the employment report called Average Hourly Earnings for Production and Non-Supervisory Employees. And it's a long-winded way of describing wages paid to most craft workers and office workers who aren't supervisors. From 2000 through 2019, that average hourly earnings for production workers in construction was 20% or more greater than it was in the broader private sector. That really was how the industry was able to attract and retain workers who had to show up in all kinds of weather, stay in not the most pleasant working conditions in some cases, and get there earlier than I like to get up in the morning. Well, in at the beginning of the pandemic, when so much activity was shut down, so many of us were cooped up at home, the restaurants and delivery companies and warehouses that we were buying from, they raised their starting pay in order to get enough workers. And that pay had been as low as minimum wage or even less for tipped restaurant employees. So the floor came up and the premium that construction was paying shrank. It's slowly being restored, but it's still only back up to 19%. So I do think construction wages are going to have to go up even more this year in order to compensate for the decline in attractiveness of construction relative to other jobs that can be done remotely or on a hybrid basis with flexible hours. You can see that average hourly earnings have consistently been rising about 5% over the last several years in construction, whereas nationwide, the average hourly earnings for production workers are now rising only about 4%. I know Kermit had a slightly different measure of wages that was lower. This is specifically for those craft workers and other non-supervisory workers. And my guess is that we will continue to see at least a 5% increase this year, perhaps even greater as we go through 2024 and into 2025. Well, here the red line shows yet another series from the Bureau of Labor Statistics, the Producer Price Index for inputs to new non-residential construction. That's a weighted average of all the materials and services such as design and trucking services used in construction. And it's had a much more volatile course. At the very beginning of the pandemic, it actually declined compared to a year earlier as so much of the economy shut down. But then immediately it started rising very sharply with record prices for lumber, steel, and copper, and very frequent and much steeper than usual increases for items as diverse as concrete products, gypsum, and insulation and plastic pipe. By the last spike occurred after Russia invaded Ukraine in early 2022. And then from June of 2022 through most of 2023, prices moderated. For a few months, they even dipped below that zero line, meaning that they were lower than they had been in the same month of 2022. Just in the last few months, they've moved up again, but only about 1.5%. Now, going forward, I think that we will see gradual acceleration of materials costs, not across the board and not into double digits unless we have some extreme event happening. But I am worried about cement shortages that showed up in 2022. We're already seeing fairly steady increases in cement prices. And more recently, wall insulation has been very difficult to get if you're looking for mineral wool insulation. And those prices, I think, are also rising. The biggest problem with the supply chain has been with electrical equipment, specifically switchgear and transformers, and in some cases, the electronics for elevators or HVAC or security systems. And these problems look like they're also going to continue through this year. Well, let me move on to a comparison of the prices that contractors are facing versus what they've charged. And the blue line comes from a series called the Producer Price Index for New Non-Residential Building Construction. BLS creates this by asking a group of contractors what they would charge to put up a particular building. And you can see that those bid prices stayed flat all the way through 2020, even as the input costs, shown by the red line, were soaring. Over the next 2 years, the bid prices almost caught up, but lately the bid prices have been flat again, while the input costs have been rising. We can expect a lot of volatility, or at least we can't predict how soon the bid prices will match the input costs. But given that I expect input costs for materials to be rising from, say, 3 to 5% this year, and the labor costs for those production workers up 5 to 7%, at some point, bid prices will have to be going up once more. Well, one last look at what's happened to materials costs. Cement prices, as I said, which used to rise only once or twice a year and then slip back sometimes later in the year, up 5% in the last 12 months. And that's been pushed through to ready-mix concrete, up 7%. On the other side, diesel fuel down more than 6%, but just a few months ago, that was rising at a 30% year-over-year rate at the producer level, that is to say, the refinery or the terminal rack. So the takeaway here is that prices can be very volatile for individual items, even when the overall indexes remain pretty calm. Well, let me go on to where I think construction spending is headed. This is a series that the Census Bureau updates on the first day of each month. And you see everything here in the black, meaning growth from March of 2023 to March of 2024 for projects put in place. We'll get a different perspective in a minute from the folks at ConstructConnect. But let me dig into this a little more. The next slide shows some of the 160 categories that the Census Bureau puts up on its website. And again, most things in black, but some of the subcategories have been in red. And also there are a couple of surprises in here. For instance, office construction appears to be up, but that's because office up till now includes data centers. I'm finally able to report that the Census Bureau has paid attention to my complaints and many other folks, and they will be showing data centers separately with their May report that will come out on July 1st. At any rate, I think that going forward, we're going to see tremendous growth again this year and into next in manufacturing plants, specifically computer, electronic, electric plants, as Census calls them. These are the semiconductor fabs that lately have been getting huge grants from the Federal CHIPS Act, and also transportation equipment. There's been some pullback and a lot of worry about whether new EV manufacturers will be able to follow through on their construction plans. But for now, there's clearly a lot of growth happening in the category of EV and battery and component plants. On the third positive would be the power and the infrastructure categories, such as highway and many of the transportation categories. As you can also see, education has been quite strong for both primary, secondary, and higher education. I am concerned that higher ed is going to taper off as we see decline in enrollments and I think growing skepticism about the value of incurring huge debt to send kids to colleges, particularly with the current unrest. Well, let me wrap this up with a quick summary of where I see the outlook for now. I think the economic recovery will continue through this year, but I also think interest rates are going to hang at close to current high levels. I don't expect the Fed to cut its short-term interest rate target until December or maybe even 2025. And I think mortgage rates are currently running over 7% for the 30-year fixed rate are also likely to remain at a level that will discourage many home buyers. Nevertheless, single-family home construction will pick up from the extremely low levels of a year ago. But multifamily, warehouse, and office construction are being hit hard by tightened lending standards and rising vacancy rates. However, those things will be outweighed by strong growth in data center and manufacturing construction, and hopefully, finally, getting a lot of the money promised by the Infrastructure Investment and Jobs Act, the CHIPS Act, and the Inflation Reduction Act. So the biggest challenge for contractors will continue to be labor availability.
Morgan Stinson gave an overview of bidding trends seen in ConstructConnect's data.
Today, I'll be focusing on the commercial construction project trends from Q1 plus April, comparing them to the same period in 2023. Let's dive into the details, and we're going to start with some bidding trends here. So, in the first quarter of 2024, when we examined commercial bidding trends over the last 5 years, we observed the U.S. bids are performing better than in 2019, 2020, and 2021. However, there is a noticeable decline compared to the surge we saw in 2022, a post-pandemic year when many previously postponed bids resumed. In 2023, bidding activities began to normalize, and this stabilization appears to have continued into 2024. Now let's dive into the Canadian bid volumes on the next slide. All right, in Canada, the bidding trends represented a distinct pattern from the US. After rebounding significantly from the lows of 2020, there's been a consistent growth compared to 2019. However, we've observed a mild retraction in bidding activity in more recent years. The shift from 2023 to 2024 reflects a strategic adjustment at ConstructConnect how we categorize service, maintenance, and supply projects. Despite the slight decline in overall bid volumes, there was an increase in general building and civil projects, contrasted by a decline in service, maintenance, supply bids. So next, we'll shift over to the new trends in the U.S., new project trends. Our team diligently enters new projects at both the planning and bidding stages. In 2024, the volume of newly created projects is on par with 2019 and 2021, and it shows a slight increase over pandemic-impacted year of 2020. Though we're slightly behind in 2022, there's a notable 7% increase compared to last year. You might recall from my previous slide that the bid volumes were flat year over year, raising the question, why the increase here? This data includes newly created planning projects in addition to bidding projects. And so far in 2024, we've observed an 11% increase in planning projects compared to last year, reflecting renewed focus on initiating new developments. On the next slide, we'll discuss U.S. project year-over-year project value changes. All right. So as we examine the construction spend, there's a notable uptick in both civil and building segments across the U.S., despite flat bid volumes, and of course our observed planning increase, which we discussed earlier. This surge, combined with the rising cost of construction due to various economic factors, has led to an increase in year-over-year value of construction projects through April. We're very interested to see if this trend is going to continue throughout 2024, so this is something that we'll be keeping a close eye on. Moving through the next few slides, I'm going to review building uses in which we have seen both growth and declines in the United States and Canada. All right. In the US, we're witnessing a noticeable resurgence in sectors like retail and restaurants. Industry professionals report an upswing in activities such as grocery stores being constructed and companies repurposing existing locations from one brand to another. Additionally, there has been a rise in construction for educational and medical facilities. Notably, several experts suggest that healthcare could be a prime candidate for repurposed spaces, which may be contributing to this increase. On the next slide, we're going to explore sectors where there has been a decline in activity. In the United States, we continue to observe declines in office building use, and recently municipal projects have started to retract. This downturn is largely driven by the escalating cost of construction, and the same budgets that once sufficed are no longer adequate, leading to some projects being temporarily put on hold. Additionally, while warehouse and distribution centers were previously areas of growth, particularly with major companies initiating new facilities, we've noticed just a slight decline into the start of this year as construction has commenced on some of those large-scale projects. The initial surge in activity is just slightly tapered off. Coming up next, we're going to shift our focus to Canada, and we're going to review the sectors that have experienced growth there. In Canada, we've observed significant growth in certain sectors. Educational and municipal buildings have seen an uptick, as have multi-residential projects. The increase in multi-residential projects can partly be attributed to Canada's current housing shortage, highlighting a responsive surge in construction to meet this demand. Additionally, there have been noticeable year-over-year increases in transportation terminal projects, reflecting ongoing investment in infrastructure. Next, we'll shift our focus to the sectors that have experienced some declines. Right. Similar to the U.S., what we've observed in the U.S. is that Canada is also experiencing a decline in office projects. In addition, there's been some noticeable decreases in fire and police projects as well. Most of this due to budgets, spoke to earlier about the cost of construction now being higher than it once was, and that's why we believe we've seen a decline in this building use. So overall, we have some similarities between the US and Canada, but definitely some very distinct markets.
And Michael Guckes took a look at the summer starts forecast for construction, as well as project stresses and the continued influence of interest rates on the economy.
So I am very pleased to present to all of you our summer 2024 starts forecast. And this one here, I'm going to start just from the top down, but 2024 residential remains in the strong single digits from our prior outlook, so that's good. But underlying this was a substantial reduction in our multifamily outlook. It was at 6.4% for 2024, and now it's at 0.1%, so about flat. This will be partially offset by some improvement in our single family outlook. For non-residential building this year, we are now at negative 4.8%. That is down further from the negative 2.4% outlook we had at the start of the year. For total non-residential, that is at 3.3%. That was, I apologize, at 3.3% at the beginning of the year, and now we have reduced that slightly to about plus 2%. This is, I think, fairly copacetic with what we've heard from the other speakers today. U.S. grand total, that starts forecast has now been lowered from 4.5% to 3.3%. And so in general, we are tempering a lot of our forecasts just given the macroeconomic conditions out there that so many of you are already aware of. High level downward revisions. So if we look below into our subcategories, one of them that I would point out is commercial. We were at a 9.9% forecast for this year. That has now been reduced to 2.3%. Not everything I have to say, of course, is on the downside of this. There are some good positive forecast changes out there as well. We continue to see mega projects, for example. Those are projects in excess of $1 billion in value. They will play a significant role in total construction. Right now, we see them tracking at about 15% of all first quarter 2024 spending. So that's very good. Total engineering has been revised higher. Last quarter, we had forecasted 12.7%. We are now a little bit more bullish on that segment at 13.2% growth. Total institutional has improved as well. It was down almost 4%. We've raised that a little bit. I want to share with this group our subcategory outlook. So within the major segments that I just talked about, we can see the dispersion of results here. And I think it's really important to show this because, again, where or how you play in the construction market is going to provide you a very different experience this year, depending on where you're playing, in a sense, or what you are focused on doing, right? And so we see at the top of this miscellaneous civil. Miscellaneous civil is something I'm going to point out what that is exactly. It includes power infrastructure, parks, landscaping, railroad and subway work, military non-building, athletic fields and courts, swimming pools, civil demolition work, electrical work, fencing, machinery and supplies, tunnels, oils and gas pipelines. So there's a lot in that category that I just want this group to be aware of. Some of these subcategory groups will be heavily impacted by public spending. And I should note that if we look at how much money the government is bringing in through sales tax and various other receipts, that amount is down 2% since hitting a peak in the first half of 2022. So we've gone not quite 2 years now where the government is actually seeing a decline in the real value of the amount of money that they're bringing in and can turn around and then spend without, of course, going into deficit spending. In this slide here, I also want to point out that office will be challenged by the challenging market forces already talked about, the enduring work from home trend. I think Ken or Kermit talked about that. And then also interest rates, of course. Nursing homes and assisted living will be impacted by demographics. But then also we need to think about a more nuanced thing, such as the legislation that will change how many registered or qualified healthcare workers are needed per the number of residents. And that could have a very big constraint on the number of usable nursing facilities. So these are some of the things that our group continues to look at very carefully. The key starts and takeaways. So in this, I will not read this slide, but these are some of the big points I want to bring to your attention. As you read our starts forecast this quarter, I want you to consider that each subcategory, again, has its own market cycle timing. Some categories rise early in an economic cycle or in an economic boom, while others are late bloomers during a boom or just a business cycle in general, right? So if we think about it, right, government offices and industrial labs, school labs, et cetera, they are coming off of historically high 2023 results. So some of that slowdown is simple business cycle things. Our residential outlook, well, we expect that to nadir here, to bottom out in 2024 before turning higher. So we're at the bottom of that business cycle. Hotels, shopping, and amusements, they all reached lows in recent years. And we believe we are primed to see long-run growth there for you. So as I was pointing out, right, there is the business cycle, and then there are certain shocks to those cycles, right? Some of those shocks can be good, some can be detrimental, right? But the point being that not all those shocks are going to lift all of our subcategories in the same way. And so firms out there, our audience, needs to be careful and consider about how they're picking their verticals, or better yet, pick multiple subcategories or verticals that you want to serve in order to reduce some of this business risk and some of the volatility, right? And so I have listed here a couple of the big drivers of reshoring and national security issues. Those are driving a lot of the mega projects. And then, of course, with mega projects come the ancillary projects around those. You have energy and the electrification of our economy. That, we believe, will continue to be a very strong trend for many of the verticals that are either directly or indirectly benefiting from that transition. We have the growth of civil projects. And then on the other hand, of course, we have interest rate sensitive markets. And we've already talked about office spaces and other places where it's the cost of financing can turn your return on investment predictions upside down, or simply fail to bring those returns to the necessary level to make that project profitable. On the Canadian side, lots of things to talk about here. Our grand total outlook is now 4.4%, sorry, negative 4.4%. That is significantly down from our nearly 8% outlook that we had at the start of the year. This revision was caused by significant decreases in our total engineering outlook. That outlook started the year at plus 21%, and now it's negative 9%. Every engineering subcategory, unfortunately, is down now. Total residential was at a 4.1 expected growth rate for the year. That is now negative 2%. And we have to remember that residential makes up about 1/4, a little more than 1/4 of the grand total spending here. Neutral is institutional. That has not changed, but it does remain challenged. And then on the good side, to end on a good note with this slide, we have to remember improving commercial conditions. For this year, commercial was expected to be down 2%. We now have a 2024 outlook that is plus 2%, so that's good. And of course, for more information, I threw a lot of information here at this group. You can go to our website, and under our economic resources, you can download the latest PDF of our construction starts and really dig into these numbers in detail. So our project stress index, again, something that we are very excited to be bringing to the market. This is a index that looks at the challenges facing projects from their ideation to really their groundbreaking. So what is happening to projects, the success of projects, I should say, as they move from the very early blueprint stages onto final bid. And we can see here that our index begins in 2021. So 2021 is a value of 100. And what we're seeing essentially now is that overall conditions are about 30% more difficult now than they were 3 years ago. That has, as you can see, been, I think, largely a result of the rising interest rate environment that has challenged all of the categories of construction that we're monitoring. Of the three components that make up the PSI, abandonments, I would argue, is probably the most severe form of project stress. And unfortunately, what we have seen since the third and fourth quarters of 2023 is that abandonments really, for the first time ever, are sustainably lifting the index. in a way that it has not really ever done before, except for a brief period in early 23. You can see that small orange spike there that was fairly temporary. But prior to that, in more normal times, I would argue, we normally don't see abandoned project activity taking the lead in our index. And so this, I think, speaks to a lot of the challenges that have already been spoken to. It just simply quantifies some of that challenge. And then the other thing that I would pose is that how do we as a community deal with this problem? In other words, what can we do operationally speaking so that if a project that we are depending upon or hoping to depend upon is either put on hold or is abandoned or otherwise challenged, how can we operationally prepare ourselves to handle those hiccups? And then lastly, just finishing up here, I'm going to talk briefly about this buy versus build calculus, right? As we already talked about, the all property index, this is, I believe, the same one that was spoken of earlier, just indexed a little differently here. We're seeing declines in the existing value of construction, while at the same time, of course, the actual cost of building it, as both Ken and Kermit pointed out, is much higher than it was back in 2020. So the challenge, of course, is how do these dynamics affect the demand for new construction versus buying something that is existing and then renovating it? And certainly our renovation numbers have suggested that there's a lot of opportunity in the renovation market renovation opportunity there for us as a construction community. So those are the major points. The other things, of course, as you can see here, top of the list, the cost of financing is so much higher now than it was. And it's not just from the banks, but it's also to insure the property as well. Just all of the costs associated with financing new work is just tremendously higher than it was. And so we need to continue to understand, how long will this higher for longer rate environment that Ken was speaking about last, and what can we do in the interim to manage that? And then this part here, just speaking to, again, what is happening from a banking perspective. Banks are by no means excited about this part of the market, the CRE part of the market right now. You can see here that the number of banks increasing their loan standards for CRE loans is just about as high as it's been in recent history, aside, of course, from a brief surge during the very beginning of COVID. But we are seeing the banks in some other areas like C&I loans beginning to soften a little bit there. Again, the whole reason I'm pointing this out is because those firms that are really dependent on financing for both operations and for those owners and developers looking to initiate new projects in the interim period here, there's going to continue to be some difficulties around that are, as I've mentioned before, tempering our outlook. So, a couple of considerations for this group, right? How are we going to play the landscape, right? We've talked about the distribution of outlooks here, everything from other civil to, our office space outlook. So how do we play the game? Where does your revenue strategy take you if you play a diversified game and look at serving not just one subcategory, but multiple categories? How will your firm manage or respond to projects that fail to cross that finish line, that are unexpectedly put on hold or delayed, or worst of all, abandoned, right? How can we have some extra work in the pipeline there, or at least hedge those bets, right? And then lastly, dealing with higher for longer interest rates, how do we, as a community, respond to that drag on construction demand?
Finally, Chief Economist Alex Carrick did a deep dive on how demographic changes are shaping the economies of both Canada and the United States, as well as how upcoming elections in both countries could affect the construction industry and overall economy. And he also looked at rising costs.
Michael and I have had the privilege of appearing on the Construction Record podcast. And the most recent one we did, we talked about how general contractors could diversify, because there's a lot of uncertainty in construction these days. And some of them are obvious by type of structure, public versus private, new versus renovation, modular versus traditional. But there hasn't been a lot said about geographically. So what I'm going to do today is I'm going to talk about some of the numbers on how the United States and Canada are changing fairly dramatically in terms of some of the population shifts and some other key indicators. This first slide looks at the state populations and the national population. And over the last year, the two key numbers for the US as a whole are a population growth rate of 0.5% and an addition to the resident count of 1.6 million. Now, among the states, there are 4 states that account for really the bulk of the resident count. 1 in 3 Americans lives in either California, Texas, Florida, or New York. And it's Texas and Florida where there are very significant increases in population, 1.6% compared to that 0.5% for America as a whole. And in California and New York, there are actually declines in population. So Florida and Texas are right up there. The only other state with a faster rate of increase in the past year was South Carolina at 1.7%. And here what I've done is I've looked at the 20 metro statistical areas for fastest growth over a 3-year time period. And there are 54 cities in the US with populations of 1 million people or more each. And these are the 20 with the fastest increases. And I've color-coded it here. And on the left, and the reason for doing this is I'm not sure that people realize the degree to which the South is surging ahead. And the first color coding is to the far left. And all those cities are in the South. And there's 14 of them that are shaded sort of pink there. And this is the South is defined by the Census Bureau. But I think most people would consider that Phoenix is also in the South, and Las Vegas, and Tucson, Arizona. They're called West by the Census Bureau, but they're really in the South. So of the 20 top cities, 17 of them are in the South. And then the other shading on this table is for the 3 states, Texas, Florida, well, 4 states, I guess, Texas, Florida, and the Carolinas. And you can see that that's where most of the population increases have been occurring. And looking at the level, the increase in level of population, it's the same thing. There's 15 top cities, and 13 of them are shaded for being in the South. And Phoenix is in the South, so I know it says West there. But 14 of the 15 fastest 1-year increases, this is the level of population, are in the South. And again, you can see how dominant Texas, Florida, and the Carolinas are. Now, there are 19 cities or CMAs where the population has declined over the last 3 years. And 19 out of 54 cities means that there's 1/3 of the major cities, or the cities of 1 million population or more, where there have been declines. And it's the cities that you sort of know about and you expect to be on this list. It's Los Angeles and New York and Chicago and San Francisco and Pittsburgh and some others. Now, some of them have stabilized in the latest year, but there's still quite a few cities. So again, what we're talking about is this shift that's taking place in the country. Obviously, you'd want to see what the population change is related to GDP growth. And I looked at the GDP numbers, the quarter-to-quarter percent change annualized for the 20 largest cities in the United in the United States, or 20 of the 20 largest states in the United States, and took the average GDP growth over the past 2 years. And surprise, surprise, it's Florida and Texas at the top of the list. And both of those states have GDP increases that are almost double what the GDP increase on average, quarter to quarter, has been for the country as a whole. And then looking at our own ConstructConnect's start statistics, they're remarkable. I think they're really tell quite a story, last year anyway, that Texas, by dollar volume, had more than double, or almost double, the dollar volume of construction starts, total non-residential construction starts, as California. Texas has a population of 31 million and California 39 million. And what kind of projects have been taking place in Texas? Well, that's just a real grab bag of projects, but it's also runs the full gamut. It's things like LNG exporting facilities and the chip making plants, and it's giga truck plants, or at least the one by Tesla, and battery storage units, and that's also Tesla. And in terms of the subcategories of total non-residential starts, Texas was more than double second place California in 2023, and about 50% higher than second place California in terms of heavy engineering starts. Now let's look at housing starts. And the way that you measure this is in terms of residential permits in units. And again, we see some of the dramatic shifts, because 3 of the 5 top cities in the country were in Texas. And those housing start numbers for Houston and Dallas-Fort Worth are huge. Those are really high numbers for permits or housing starts. Coming to Canada then, remember that I said that the US growth rate in the latest yearly numbers was 0.5%. Canada's population increase in the latest annual result is 3.2%. And I said that the US had an increase in resident count of 1.6 million. Canada's increase in resident count was 1.2 million, not that far off. Generations of Canadians have grown up believing and using as a rule of thumb that the United States population is 10 times greater than Canada's. Well, if you go to the population clocks on the internet and you do the simple math, you will find that that ratio now is approximately 8 to 1. It's actually 8.3 to 1, because the population of Canada has been increasing so rapidly and so dramatically. Now, in Canada, it's Alberta that's sort of the comparable province to what Texas is in the United States. And the country as a whole increasing at 3.2%. Alberta's latest annual increase was 4.4%. And among provinces, the next was Ontario at 3.5%, then British Columbia at 3.3%. And here's the population change in Canadian cities. The city that really stands out is Toronto, of course. And there's 3 cities in North America where the increase in population and the annual increase in population the last couple of years has been 100,000 or more. And if you think about an increase of 100,000, that means a lot of construction. Now, here's another statistic, and it will be particularly of interest to Canadian registrants, because this kind of blows my mind. The population of Toronto, not including outlying regions like Guelph and Barrie and Oshawa, the population of Toronto, compared with the two next biggest cities in the country, Montreal and Vancouver, is 93%. Toronto is almost the same population as Montreal plus Vancouver. And housing starts in the Canada's biggest cities. It's Toronto that's the leader. But last year, for the first time that I can remember, Calgary replaced Montreal in third place. Montreal was bumped to fourth. Vancouver was second. And if you look at Canada and the United States combined, housing starts in Toronto would have placed third overall, although still considerably behind Houston and Dallas. And Vancouver would have been eighth overall. Okay, so that's the end of looking at just the demographics, and I've got some other comments about construction and what to expect. What are the big issues over the next year and a half? Well, one of them is that politics matter. In the United States, there's the presidential election coming up in November. And in Canada, there's likely to be a federal election in 2025. And just to give you a couple of examples here, if the incumbent parties lose, there's likely to be a considerable scaling back of the energy transition efforts that have occupied our governments over the last several years. So that's one. A second point is that the central banks in both countries are likely to find that they no longer have quite the independence that they once had. And there's a whole bunch of other things where politics count. So a second major issue is that everything is more expensive. And we're all waiting for inflation to come down and interest rates to come down. Now, do you have any idea what the biggest line item or the biggest year-over-year increase was among line items in the U.S. Consumer Price Index in March? Well, surprise, surprise, it was motor vehicle insurance, plus 20.2%. And some of that is probably due to the cost of repairing electric vehicles. And there's currently a backlash against electric vehicles. And we'll see where that goes. Now, in terms of the construction sector, I'm not sure whether it was Ken or Kermit who mentioned it, but there's an increase in material costs since before the pandemic of about 40%. And if you graph the producer price indices for the various components that go into construction, lumber is back to sort of where it was before the pandemic, and that's because housing starts have fallen. Steel is off its peak, aluminum's off its peak, copper's off its peak. I'm talking about the long-term picture on these PPI indices. But cement, ready-mix concrete, and gypsum, they're all still at their peak. And then there's a whole range of products that you look and you see what the trend line was before their peak, and you extend out that trend line, and where are we now? Well, insulation materials is up there. The really big ones, they're way above their extended trend lines, are things like paint and glass and lighting and plumbing fixtures and heating and cooling equipment and escalators, elevators, and construction equipment generally. So the prices of these things are way high. And they're likely to stay there unless there is a really serious contraction in the economy. So that was my second point. Everything's more expensive.
Thanks for listening to the Construction Record Podcast. You can hear us on Amazon Music, Apple Music, Spotify, and at theconstructionrecord.libsyn.com, as well as the Journal of Commerce and Daily Commercial News websites.